All right, well, one of the catalysts today has been a debt downgrade. S&P downgrading multiple U.S. banks, citing tough operating environment as well as liquidity concerns. KeyCorp, Comerica, Valley National, UMB, and Associated Bancorp are all in the crosshairs of this downgrade, and then there were warnings on several others. Nevertheless, Andrew Pyle, who's our guest for the half hour, has been bullish on the banks. We've been seeing, we talk about a melt up. We've been seeing a little bit of a melt down. The Canadian Bank Index is at a 2-month low. The U.S. Bank Index is at a 1-month low. And even that doesn't fully account for the real pain we've seen in the sector.
Yeah, and there's multiple variables going on here from, what is the impact on lending if we have a slowing economy, whether on the consumer side, talk about commercial real estate, what are the pressures in commercial real estate, how does that impact the banks, both in Canada and the States. And I think in the States, again, you've got those added problems of the fact that we've got tighter regulation in the banks. We've got deposit pressures for banks because there's alternatives for savers. And I think we're just going to get through this. And this is where I think you're hearing a lot more.
The point of all that is we know that. We've been hearing that. And is it priced in?
I believe it is priced in. And I think, we came out of this shock wave of the spring, and then we had this kind of melt up in U.S. bank stocks after because we didn't get the crisis everyone said. This is a little different. This is not where, the sector in general is in trouble because the U.S. banking sector is not in trouble. It's still well capitalized. But you do have these names that are going to be challenged in this environment. And I think, when you look at these ratings downgrades, it's almost like, well, we knew that was going to happen. I mean, these are rating downgrades that you could have issued 3 months ago. Right. There's no, smartness about the timing or when these happen. And so I don't think investors are really shocked when they hear these stories, Amber. But I do think it really highlights the fact that you've got these unique challenges in the U.S. market that still have a ways to go through.
And yet, fine, you can see the pain in the regionals. I'm looking at Citigroup, which is now down 7 days in a row. It's trading at the lowest level since October 2022. And I mean, there's no headlines. There's nothing, it's just been a quiet grind lower.
Yeah, part of it is where do investors want to put their money, right? And we're still dealing with an environment where investors are more drawn to growth, which would be the tech sector, the AI story. And they look at the U.S. banks, even though the valuations, I think, are incredibly attractive right now.
7 times earnings, 5% dividend yield on Citi.
Yeah, and then when you look at price to book, for example, on a lot of these, especially the regional names, I mean, they're still extremely cheap. So investors should be looking at that sector, but it's not exciting. And it's again, people have very short memories that, they remember back to the spring, what happened in the sector. So this is going to be a long-term play. So when we're adding exposure to, for example, U.S. banks, this is over
Citi
a very long term. Citi be one of them. We have a regional bank ETF that we continue to put money to work in. And it's really just picking away at opportunities, not to make 20% in the next 3 to 6 months. It's really looking at this over the next 5 to 10 years as the sector stabilizes.
You are a stock picker, so it's interesting that you're chipping away at the ETF. Is that to mitigate sort of one blowing up? Yeah,
well, I think that's a very important thing to do right now, is that we don't know where those items are in the closet, for example. And, we were talking about bonds earlier in the show, Amber, and what's happening to yields. Keep in mind what happened to a lot of these banks that, didn't do too well earlier this year. It was balance sheet issues. All right. And if we're doing mark to market right now on some of the banks out there in terms of what their balance sheets look like with bonds that have now deteriorated again, we don't know who has got the worst exposure. So, yeah, the ETF approach for us on the regional bank side makes most sense.
Where are the white knights in the banking sector right now? You had some of the cavalry ride in. Warren Buffett rode in during the financial crisis in a very advantageous way to him. But still, he's sitting on this record cash pile, not riding in here. Why aren't we seeing, sort of our saviors of the market come into this sector?
I think basically, Amber, because they're not sure either what the near-term implications are. We still don't know what the regulatory environment is going to look like in the U.S. And the other thing that I think we'll probably talk about down the road is, are we going to see increased M&A activity in the U.S. banking sector, right? Because a lot of analysts will say that has to happen, right? You cannot have a small bank operating in this really challenging environment, especially from a regulatory cost point of view, keeping up with technology. when you're a small bank, you're going to have to merge with other banks. And I think the white knights, to your point, probably are looking at how does this unfold over time, and you'll see money put to work where they think those opportunities are best.
The retail stocks are all telling us a story of a consumer that is slowing down. That filters through the banks. In Canada, we have a housing market. We have, a consumer that still is holding up. But on a relative basis, how are you thinking about how that feeds into the Canadian banks versus the U.S. banks?
Well, the Canadian banks, I think, have one benefit, and that is when we think about the housing market, for example, and I'm not saying the U.S. housing market is, worse than Canada's, but, we've got a demographic variable at play right now in terms of population growth in Canada that is going to give some support to the housing sector in general. And I think it's going to give some support to, overall consumer spending and retail behavior. So I think from that point of view, the Canadian banks have a bit of a buffer that the U.S. banks do not have. I still think, Canadian consumers are in decent shape. The one thing that we're a little bit more mindful of now, Amber, is taking a look at the increase in debt servicing costs that is taking place in Canada right now. And depending on the statistics that you look at from the Bank of Canada, in some cases you're looking at a 50% increase in the cost of servicing debt. That ultimately will feed into weaker consumer spending, but I don't think that that's going to be a massive headwind for Canadian banks.